Welcome to our CFP Exam Prep podcast. Today we're diving deep into long-term capital gains tax rates, a crucial topic that frequently appears on the CFP exam and often trips up candidates. Let's break down the fundamental concept of long-term capital gains rates. These are preferential tax rates applied to assets held for more than 1 year. The key rates are 0 to 15% and 20%, and they're determined by your taxable income thresholds. For 2023, single filers with taxable income under $44,625 qualify for the 0% rate. Those between $44,625 and $492,300 fall into the 15% bracket. Anyone above $492,300 pays 20%. For married filing jointly, these thresholds are $89,250 and $553,850 respectively. A common mistake students make on the exam is assuming these rates apply uniformly to all long-term capital gains. They don't. There are special cases that the exam loves to test. For instance, collectibles like art, antiques, stamps, and precious metals are taxed at 28%, regardless of your income level. I've seen many exam questions where candidates miss this exception and automatically apply the standard rates. Another special case is Section 1250 property, which involves depreciated real estate. When you sell depreciated real estate, the portion of gain attributable to depreciation is taxed at 25%. This is called depreciation recapture. The exam often presents scenarios where you need to identify which rate applies to different portions of the same transaction. Let me give you a practical example. Imagine your client sells an investment property for $500,000 that they bought for $300,000. Over the years, they claimed $50,000 in depreciation. The exam might ask you to determine the applicable tax rates. The $50,000 depreciation recapture would be taxed at 25%. The remaining gain would be taxed at either 0%, 15%, or 20%, depending on the client's income level. When studying for this topic, focus on understanding the income thresholds and their application. Remember that the gain itself can push someone into a higher bracket. Another testing point is that these rates apply to qualified dividends as well as long-term capital gains. Here's a strategy tip for the exam. When you see a question about capital gains taxes, first identify the type of asset involved. Is it a collectible? Is it depreciated real estate? Then look at the holding period and the client's taxable income. This systematic approach will help you avoid common pitfalls. The exam also likes to test the netting of capital gains and losses. Long-term losses must first offset long-term gains, and short-term losses must first offset short-term gains. Any remaining losses can then offset the other type of gain. Students often forget this ordering rule. Finally, remember that these rates are just part of the larger capital gains picture. The exam might combine this topic with other concepts like cost basis, holding periods, or wash sale rules. Your success depends on understanding how these pieces fit together. Master these concepts, and you'll be well prepared for the tax portion of your CFP exam. Remember to practice with questions that combine multiple aspects of capital gains taxation, as that's how they typically appear on the actual exam.